well, talking about his new initiatives. So I want to introduce Josh Roach. He's from Lloyd Capital Partners. He's been heavily involved in the family office space for many years. He does a lot of residential real estate and some private equity direct investing. So Josh, do you want to introduce yourself and then pull up your presentation?
Sure. Marty, presume you can hear me okay?
Yep.
Great. Hello, everybody. Marty, thanks for having us today. And I'm happy to take questions from you all on things that we're doing in this time frame, kind of post-COVID or mid-COVID era. Just pose your questions to Marty and he'll manage through that. And in the absence of questions, I'll start by giving a little background on the single family office that I manage and some of the different asset classes that we historically have been involved in and what we see kind of going forward. So I work for the single family office of the Henry Demas Lloyd family. It's again a single family office. There's one client with about 50 different family members in that family. And we really focus on three key areas: technology investing, direct technology investing, direct residential real estate, and private debt. And those are the three core areas where we run internal strategies. Everything else we do some public market investing and some fund investing. Like many offices, we spent the last 10 years getting out of our hedge fund allocations for the most part, and have become more active in the last 10 years in developing internal expertise around the three core strategies I just mentioned: private debt, residential real estate, technology, and a concentrated portfolio in some public market stocks. We're based in, the family's kind of all over the country with some international, but we're based in Boston, Massachusetts, and travel, like most of you in other family offices, fairly frequently around the country and internationally to network with our other co-investors and also just visiting portfolio companies where we need to. And I'm happy to talk about any particular areas before we kick off, and if not, I'll chat with you a little bit about how we think about single family residential real estate today. It's also known in the industry as SFR. SFR, or single family rental, is different, but a close cousin to multifamily. And so I'll just pause for a second and see if there's any questions before I kind of drill down further into my presentation. Okay, with that. Marty, can you see the?
Looks good.
Okay, great. So I'll just say, for the last 12 years, the family's been investing in residential real estate. We started out doing a lot of distressed stuff coming out of 2006, buying a lot of single family homes, doing light value add to them, and then selling them quickly to a set of kind of ready to go investors. And over the last probably about 10 years plus, we've probably done over 1,000 transactions in that space. We've also got our hands dirty with actually building homes. That's not a strategy we really like very much. It's fairly intensive from a CapEx standpoint, and don't really love that. And about 5 years ago, we started exploring single family rental market. And really that came out of the Great Recession. What was happening in Southwest US is the homes that we were buying and fixing up and then selling to investor pools quickly, almost overnight in 2012, those home prices went away. They started going up quickly. We couldn't figure out why, and we quickly realized there's a company called Colony Capital that is today, through a number of consolidations, called Starwood Capital, and then Invitation Homes is the public ticker to that. Long story short, they were buying up all these homes in our home market, and they created a strategy to buy these homes, but instead of reselling them quickly, as we had done for the last 5-6 years, they were literally building them up, doing light renovations to that, and then renting them out to folks. And we thought that was interesting. We kind of missed that play, so we directed our energies into the southeast of the United States, and we started identifying target MSAs that we liked and started working with operators who had expertise in that area. And that's what we do today. We allocate our capital and work hand in hand with single family operators who understand their local geographics and the demographics, and we provide capital and technological expertise, and we go to market to them, and we're building longer term SFR portfolios. Those portfolios, really are underwritten to provide a set of income and a set of cash flows that we can pay out to the family members or to investors, and or that whole portfolio can be sold to the street, to institutional investors who are seeking a yield-based investment. And so the goal really is to build up portfolios of single-family homes and sell them to larger institutional investors. And hopefully you're getting a cap rate compression track. And if you're not, you're earning a strong yield along the way. So that's kind of what we've done. I'll tell you kind of the case for single-family rental today in the market. As the screen kind of indicates, there's significantly favorable demographics today. You've got a ton of new student debt today that's really precluding people to go out and buy new homes. And so you've got this thing called household formation. You've got the millennial generation and soon to come up Gen Z, who are moving out of their parents' homes and so forth, and they need a place to live, and even an entry-level place. But as you know, home builders were not incentivized post-Great Financial Crisis to build a lot of entry-level homes because there was no good pricing model or profit model for them. And so really they ended up building mid-priced and higher-end homes. So even though household formation was still growing in the United States, you still have, 1 to 1.5 million of new household formations every single year. That's people coming out of their parents' homes into their own homes. We didn't have enough homes being built. So what happened is you have the structural imbalance of people who required housing don't necessarily want to live in an apartment complex for a number of reasons, and there's just not enough homes available. And so because of that, you have rents that have supported these household formations moving into single family homes. And so you've got historically strong rents. So that's what we've done. So we started buying these assets at below replacement cost. So that was interesting in the Great Financial Crisis. And then over time, as the cost of labor has gone up and the cost of materials has gone up, it's cost more money to actually build an entry-level home. And so today our goal is to actually buy those homes and we can buy them at about 25% discount to what a replacement cost would be. So I'll move forward on this. Let's see if I can do this here.
Josh, and any geographies that you like in particular? I know you talked about Southeast.
Yeah, I'll jump to that for a moment and I'll come back to this. So our geographies, as you can see here, that we really like the demographics in the Southeast, right? You've got job growth happening, obviously outside of this COVID issue, but historically you've got really strong above average national job growth in the Southeast regions. We expect that to continue. I think you heard Peter talk quite a bit about that. We're on tap for that as well. So we identify markets that have above average job growth and really strong demographics generally in these different regions. So I think that probably makes sense to most people. So going back to the top, aging millennials, right? These are the people that are moving out of their parents' homes. So here's what's really fascinating today. Because of the Great Financial Crisis and so many people waited in their families' basements before they could move out, there's literally a backlog of over 5 million people literally waiting to go out and move out into the world on their own into a home. And on top of the 5 million backlog, there's about a little over 1 million each single year that needs to do that. So there's a significant backlog of people who need somewhere to live, And not all of them want to live in an apartment complex for a number of reasons, which I'll go into a minute. But just think about this. 30% of all renters in the United States are looking for a single family home. And so that's fascinating. So the goal is, where do they go? They go in, they look for homes that are rented. Typically, this market was served by mom and pops. You know, they make some money, they buy a home or two, they fix it up and they rent it out. And they have anywhere from 5 to 10 to maybe 15 homes over the course of 5 to 10 years. And that provides rental income for them. And then when they die, they sell those off. Well, that kind of whole market segment has institutionalized over the years. Now you've got larger players. In fact, you've got a handful of public companies that have taken this industry and institutionalized it. Now they trade on the public markets and they buy homes and rent them out. And so what we really are focused on is we're going out and building small portfolios in combination with operators. And our goal is to sell those portfolios to those public REITs or other large kind of Wall Street players. Let me move to the next slide here. This is just a basic slide on, you can see the millennial generation here. It's a significant in population size. It's fascinating about millennials. You know, they're different than, of course, the generation prior in many ways, but one is, as you know, they want to rent things, right? They don't necessarily want to buy things. They're renting cars, car sharing, those types of things they don't necessarily want to own. What they learned after the great financial crisis is many of their parents and even some of them themselves, they found themselves owning a house, but then the job changed and they needed to go from New York to San Francisco or wherever they had to go, but they actually couldn't sell their home because there was no market. So they were stuck. So even though they had a job opportunity, they were really anchored by their home. So what they've learned from their parents' generation and from some of them is they no longer want to be anchored to a house. They don't want to have to own a house. They would actually rather rent a house or use a house for a period of time. And they're much happy to use the remaining or discretionary dollars into their lifestyle, right? They're looking for lifestyle. Obviously, this is pre-COVID. And so that's a continuing trend. So you have millennials coming out to the tune of 1.5 million per year, moving out of their parents' homes, looking for a home to rent, but a significant number of those millennials and soon to be Gen Z don't want to own the home. So you can see the demographics there moving in the favor. This is just another slide in front of you. This is really the demand and supply kind of construct in single family housing and really the net deficit of housing that's available. So what this is showing here, you can do the math yourself, but you see a whole bunch of homes being created on the demand side, the left side of this equation. And in the middle, you've got supply, and you can literally see the net deficit. It's anywhere from 250 to 500,000 different housing units every single year. That net deficit, what that happens is it creates literally a floor in the pricing for rentals. And that's why rentals of single family homes are so strong, because of the structural imbalance in housing. So historically, what you've got in the last 5 and 6 years, you've got very strong rental rates for these rental homes in those demographic areas that I highlighted before that Marty just asked about. So what's driving this? Homeownership affordability, right? So we talked about student debt. This is another reason why they're not literally owning a home right out of the bat after their first job. They've got tremendous student debt to the tune of $1.5 trillion. As we all know, coming out of the GFC, tighter mortgage underwriting. So even though the stock market went up and so forth, banks kind of turned down the screws a little bit on their underwriting, and it was harder to get a mortgage. So anyway, those are the two major things that in combination with millennials changing their preferences to renting rather than owning. And so that's kind of some of the underlying demographics and structural issues that's presented this opportunity in the single family rental space. Again, just another slide is kind of interesting to see what are the top barriers to people who are looking for a mortgage. And you can see the most out of this graph, the biggest impediment is being able to afford the down payment.
And Josh, I just saw the other day that JP Morgan has actually increased the required down payment. I guess before there was you could get a loan for less than 20% down, and now they've gone back up to 20%.
Yeah, so that's an interesting development, Marty. What's happened just in the COVID era is banks, to protect their good position they're in, they actually don't want to get to the situation where they were before. So they're actually tightening right now as we're speaking their ability to get a mortgage. So I think that's just unfortunate. It's another supportive factor for the rental market of these single family homes. It will be harder to buy a home in the future if you're looking for a home. Moving on here, this is really interesting. Again, just another way to think about this. This slide's a little bit dated, but it really goes to show you, really, if you look on the right side of this chart, everything below the median in the green, that's literally the for rent inventory available there. It's literally below. And you can see on the mid to the left side, you just don't have enough inventory of homes available. So it's fascinating.
So Josh, when I think about like homes for rent, I'm thinking like, an executive works for a company and now their company's moving them to a new location and they don't know where to buy, so they rent a home. But I mean, is this workforce housing as well? Like what's the price point that you guys are looking at?
So we operate really in the workforce housing areas where we find the most amount of value, because we like to add value to the portfolio. But this asset class is up and down, A, B, and C. So I would consider workforce housing probably kind of C plus, B minus. And I'll go through some numbers in a minute of what's just happened in April and what we expect for May. But it's up and down the segment. So we like to buy homes anywhere from $100,000 to $120,000 in our target areas. But other operators will buy homes of $250,000, $300,000. So for example, Invitation Homes, which was the public market equivalent of Blackstone and Starwood Capital, when their investment theses came together under a merger, and then they went out public, called Invitation Homes, ticker INVH. When they came to market, they're really in the B to B plus housing. So those are $250,000 to $350,000 homes. So one of the reasons we like the workforce housing is there's really no step down for those workforce housing kind of demographic. Kind of the one step down below that is Section 8 and so forth. And so these are first responders, Marty. These are people, these are policemen, these are teachers, emergency workers, make anywhere from 70 maybe to 100 grand a year, and can afford rental payments historically somewhere around 1,000 to 1,300 a month. So we like that.
Got it. So you had mentioned earlier that people who live in these large metropolitan areas like New York, they had to move to San Francisco, but they couldn't sell their homes. Do they sell their homes to you? Do you buy them at a discount and then rent them, or do they? So
historically, most of the homes we have purchased in combination with our operators were literally from banks. Banks still had them left over from the GFC, and we just went to the banks and paid cash for those homes. So we still buy them, some from banks, and we'll still also buy them from individuals on the MLS, or we'll do private sales. There's a bunch of wealth transfer going on with mom and pops, right? Someone who's 65, 70 years old has built up, 20, 30 properties. It's not institutionalized, and we'll buy those portfolios, and we'll still buy asset per asset, Marty, and we'll buy those often from the bank as well and on the MLS.
So another question. So two more questions. One is, are you doing anything in opportunity zones? Number one. And then the second one is, and this actually was something I was going to mention in the introduction, was that, how are you being impacted by Airbnb growth or just subletting? I mean, I think that Airbnb is being hit dramatically by this COVID-19. So, any thoughts?
Yeah, sure. So I don't have much to say about the Airbnb. We don't really see them coming in and impacting our space yet. We haven't really thought about that as something that we expect to be an issue. This is really long-term rentals. So on average, our rental will stay in their home for 3 years. which is significantly longer, or about 50% longer than a multifamily tenant. So this is what's interesting. If you compare this asset class, which is SFR, to the multifamily or apartment complex, you've got a longer duration of the average tenant will stay 50% longer than in a multifamily home, which is interesting there. And so we like that. And the reason why you like that, for those that understand real estate multifamily, you've got less turns per year, or just less turns. Every time you have a turn, you've got a CapEx cost and maintenance costs and deferral costs associated with that. So less turns means it's less costly to operate the portfolio. Now, you need to contrast that with, because the assets are heterogeneous in terms of, there's one on this block, one on that block, not all under one roof, you have slightly higher operating costs than multifamily. But those two things kind of outweigh themselves. So it really performs very similarly as a multifamily portfolio. The difference is, and I'm going to say pre-COVID, the difference is that multifamily historically trades at a 4.5 cap rate. These assets, trade today at a well-institutionalized portfolio at about 6.5. And so there's significant cap rate compression that could come down one day to kind of equal up to a multifamily. However, our strategy, Marty, has always been to buy these assets and operate them at about a 7% cap rate. So our goal is we operate them at a 7%. That means we buy them at like a 15% gross cap rate. By the time we're finished with all our operations, it cash flows at about a 7. And we'll then send that to Wall Street firms, for about somewhere between a 5, 5.5. And so we're expecting cap rate compression over time. And while we're waiting for that, we generate monthly cash flows.
Is any of this in opportunity zones, or is this?
Great question. So so it doesn't really work for opportunity zones. And here's the reason why. As most people understand the opportunity zones, you have to improve the asset by 50%. So if we bought an asset for a unit of 1, we'd have to put another 50 cents, another 1 of value into it. And then the numbers don't really work. What we're doing is we're buying a home for about $100,000, and we'll put maybe 20 to 25,000 in. And that ratio of the capital of the asset and the improvements don't really work out for opportunity zones. However, what I will say, an emerging cousin of this strategy is something called build to rent. Given the preference for millennials to want to rent homes and not buy, there's a new emerging trend to actually build a whole development of single family homes that has all the things that millennials want: a new asset, upgraded finishes, pools, those things, and then have that as a complete rental opportunity, and gives them ability to go from job to job across the country, and they're not tied down to a home. And so now that's an interesting area. You're just beginning to see that come up. And so we're taking a strong look at that as well. This is just an interesting kind of market here for those to get a sense of, Lily, what comprises the SFR market. And you can kind of see here, you got the total US residential market in the large circle. And then you've got in the middle circle, the single family homes. And then one smaller below that, you got literally single family rentals. And you can't, I don't know if you can see that, but there's 15 million single family rental properties in the United States today. And here's what's fascinating. Out of those 15 million single family rental homes today, only under 3% of those homes are owned by institutions. So only 3% of those homes are owned by people like the Blackstones of the world, the Starwoods of the world, the Invitation Homes of the world. And so what that demonstrates is there's significant opportunity to rise from 2% maybe to 10% or 15 or 20%. So there's a lot of assets to be bought over time to convert that into institutional portfolio. So we really see that this is an early stage of development in this asset class, and we think this asset class will continue to become institutionalized. And what I mean by institutionalized is the following. I mean cheaper debt. If you do this from an institutional perspective, I'm talking about business processes and deep technology and AI to automate your process from, identifying a home in an area to the underwriting process to automating all the upgrades that you have to do in the home. And I don't mean there's no robot actually doing the upgrade, but it's literally the reporting mechanisms back and forth between the subs and the generals and the buyers and the underwriters, and then into the property managers. So really that kind of beginning to end, life cycle to life cycle automation and technology wasn't really available. And the larger players in the market today have generated technology systems to automate that and take costs out. And those costs drive and fall to the bottom line and allow you to get, a 6, 7 cap rate value and provide significant cash flows. Resiliency in a recession.
We got about 5 minutes, just so you know.
Great, just about finished up here. So resiliency in a recession. This is interesting to see what happens here. But really, what happens is rentership increases typically in a recession, and home ownership decreases. That's what we saw after the great financial crisis, and not sure what we're going to see here. We're still a wait and hold. Margin of safety from buying below replacement costs. As I meant before, you can't go and just build a home today for the same cost you can buy a rental home today. So we like the idea of buying a rental home 25% below the replacement cost of that asset, and then charge a really strong market rate. Rental rates historically have been stable. They operate there. If you think about the rent collection rates are above the rent collection rates of multifamily. If you think about it in vacancy rate terms, vacancy rates are north of 96%, or occupancy rates north of 96%, or vacancy rates between 2 and 4%. So that's very high. People want to be in a single family rental home, and paying their bills the first thing they do. Even though COVID is going to take a toll on some folks today in terms of asset price, maybe deflation for a period of time, we actually think cap rate compression will still continue after some time. We'll put that on hold, but there's an opportunity, there's an equilibrium to be achieved to get from a single family asset down to a multifamily asset, and they should trade relatively close. And if they're only trading at a 5.5 or a 6, and multifamily is trading at a 4.5, then you can see opportunity to move down. So delinquency rate slow, as I mentioned before, rental payments are first to be paid. And here's an interesting note: as of April, we just checked on our portfolio and those of our peers, 90% of SFR rents were collected in the A and B properties. So that's interesting. And we'll see, we'll find out in another week and a half, what our main numbers are going to be. We probably expect them to come down a little bit.
Josh, is there like a hold period on this? Like, do you hold and then sell these properties, or what's the duration of the investment?
So there's two strategies. The one strategy is we build a portfolio as fast as reasonably possible, because we're buying we're buying at a really decent price. We're adding a little bit of capital, and we get that property leased up so it's operating properly, right? And then we sell that inside a portfolio to the larger players of the world. And so that's what our goal is to work with operators, provide capital and insight, and build portfolios and sell those portfolios off and get a capital appreciation on that. Those investors then are buying that portfolio for the yield. That's strategy one. The other strategy is a longer term strategy, and that is you build these portfolios up, asset by asset portfolio, and you hold on to them for a long-term yield play. And you're picking off, 8 to 10% yields on this portfolio, and it's pure cash flow. It's a great hedge against inflation. If you buy into that thesis, we certainly do. And so it really depends what the likeness of the capital is. Are you looking for a short duration, or are you looking for longer duration? And we run both strategies.
And you co-invest with other family offices?
We do. So historically, we've co-invested with other family offices, and on this point here, we think this strategy is going to continue to hold up, and we see some significant opportunities on the horizon now. And so I think there'll be additional opportunities to work with families, to put capital to work, and to operate. So let me just say two things as we're winding down here. The smaller mom and pops that I mentioned before, they don't have the operational capacity as the larger players. And because these rents aren't all being collected in this COVID area, they're going to struggle with debt service. A lot of people have levered up. So the smaller players, whether you own 5 homes or 50 homes or even 100 homes, I think we're going to see some distress in these smaller operators, and they're not going to be able to hold their assets, or they're not going to perform. So I think there's going to be some consolidation happening in the space. I think you're going to see larger players kind of eat up the smaller players. I also think there will be opportunities where some smaller players won't sell their whole portfolio, but they'll sell some assets for liquidity just to meet debt service. And so we're here to pick up those assets, and we think there'll be significant opportunities to pick up assets at much lower cost, maybe 25, 30% lower than we are today. So I think, I'll tell you, if you track Invitation Homes, which is ticker INVH, they're trading today at about 30% from their high. And the way I think about it is I think the private markets are about 3 to 6 months behind where the public markets are trading today. And I think we're going to see that price discovery. It's starting to show up probably in the next month or so. And we expect to put capital to work, Marty, in this area and accrue significant discounts on these asset sales, which I think will significantly help us. And I'll pause there.
So just another question, Josh. So one of the single family rentals, it's interesting. It's not new, but one of the old bugaboos about single family rentals was that you didn't get the same operational efficiencies from buying 20 disparate homes than from buying apartment complex of 300 apartments, right? So you could get better operations to maintain it. Any thoughts on how did this happen that operations became better? Or do you look at, when you buy a portfolio, do you look at the operational, how you're going to make it work from an operational point of view? So are these homes closely located to each other, or are they disparate across, let's say, a town like in Atlanta or Knoxville, Tennessee, or Charleston or whatever? I mean, how do you address the operational aspect?
Yeah, that's right, Marty. I mean, it's different from a set of apartments under one roof, and it's logistically more burdensome. But what you have is a set of operators that have been doing this for about 8 to 10 years that have really figured this out, and they've developed systems to really take costs out of that. So you need to be able to identify very quickly assets, and you need to underwrite them in an automated way. So our operators work with very sophisticated algorithms that identify properties, within seconds that they show up on MLS, and we can underwrite them. We can put cash bids in immediately, and we can turn those around. These operators have, often they have 4 or 5 different PhDs and coders on board that are literally developing their proprietary systems to kind of link the operational systems together. So you can take costs out that way as well. The other thing, Marty, is you want to, the better operators have property management in-house. When you have property management in-house, you can manage the tenant relationship better. And that's a little bit it flips the model on its head. A lot of people want to outsource property management because no one likes to do it, and it's often been expensive. The better players really bring that in-house, and we can accrue economies of scale, and you can manage that tenant's relationship. So yes, there are logistical challenges, but if you look at where we trade today, if you think of our NOI, if you translate that to a cap rate, it's very, very strong. And you really manage a lot of that with technology. You automate as much through technology as you can, and you have really good subs on the ground, and your teams are on the ground managing that process. And so it's really about managing good workflow, keeping tight on schedules and budgets, and knowing that you've got a buyer on the other end of your deal.
Great, that's really fantastic. Any other comments, Josh, before you close?
I would just say, I think in the next 3 months, there's going to be significant opportunities. that are going to emerge from this space. For those that want to learn more about it, we're happy to share ideas and share thoughts. For those that want to come play kind of with us or think about, you know, what are the pros and cons to allocating to the single family rental space, happy to share it. I'm happy to contrast it to multifamily, and I'm certainly around to learn more of what other people are looking for and how we can be helpful and share as a family office investor.
Perfect. And so, Josh, I'm going to send all of your contact information to the audience, as I'm going to share Carol's and Peter's as well. So thanks so much. Just want to remind everybody, Fred Nazem is going to be speaking at our next event in 3 weeks. Pat Soldano, who has a really fantastic presentation. We had a Q&A that was unbelievable when they presented in New York back in December, is going to be presenting. And we may have Sean Coe as well. We're looking at that. So thanks so much, folks, and looking forward to seeing you in the future. Thanks.
Thanks, Marty.
Thanks, Marty.